In Thinkorswim, there's a really cool feature called Think Back, and there's also another cool feature for under Analyze, a ability to show the risk profile of any combination of options and using simulated trades. We'll look at the Think Back first. We're analyzing this trade on CREE options, and with this Think Back feature, I can go back to any date in their database and look at what the options pricing was at that date for even options series that have expired already at this point in time, and am able to create back trades or simulate trades that have been taken, or that I was trying to consider the consequences or how the trade might have worked out of fictional trades. But here I'm going to try to emulate a real trade that was made and started February the 20th on CREE. So with February the 20th, the company profile, this allows me to show the options chains as they were on that date, with the options pricing on that date, and then to show down in this panel here the trades, back trades that were set up, and down in the bottom panel it shows the graphically shows the profit and loss for the trade of the options trade versus the pricing of the underlying shares of stock, which are shown in these candles here, as we call them, chart candles. And the yellow line here shows the profit and loss for the trade at that date in time. So this little yellow Think Back PL, that's the numerical net profit at that point in time, whichever date I'm pointing at. So on this date, with these trades active that I have checked, there was the highest profit we had at the time of $7,700. This is as of the end of the day of each day. This is the profit that was the open profit that was in place at the end of each day. So we took the original trade that was taken was to buy 20 of the April $37 calls on February the 20th for $2.28. So in doing that, on that date, by the end of the day, the open profit and loss was $40 loss, unrealized loss, because we bought them at 228, and the price fell by like 2 cents probably by the end of the day. I think I can even show that up here. By the end of the day, those $37 calls, yeah, $2.26 was the midpoint between bid and ask, or what's called the mark, and so that was 226. 2 cents less times 2,000 shares equivalent is a $40 loss. So if we had just left this alone and not made any adjustments, taking any profits or anything, the profit and loss would have followed this track here, this yellow line here. Would have hit an 87.90 high value here on March the 7th, would have dropped back and then hit the highest point of 92.40 with the shares of CREE closing at the highest point. This was the highest close in this whole period here on March the 20th. And then the price of the options, the option value would have dropped significantly from there until on April 20th, which was the expiration date. The value of the options would have left us with a $2,100 gain. That's shown in ThinkBack PL up there, $2,100 gain, and we would have had to probably sell these because the let's see, the price of CREE itself closed at $40, and on let's can show that here, but $40 was the price, the closing price of $40.33. That's shown up here, $4.33 on April 20th, and we would have had to either just sell these options outright on April the 20th, at whatever price we could get for them, because they're expiring. You wait till the end there and you can find yourself in desperate straits because they will mess with the pricing. So the $37, see, the bid and ask went so wide, so that the mark was $381, but we paid $228 for them. So that would have left us with a net profit of $2,100 if we had just left these options in place and done nothing with them. Now, so they would have either expired with and gotten automatically exercised to buy the shares at $37, which we could then immediately turn around and sell on Monday for whatever opening price we could get on Monday. Those could gap down to $37 and you lose all the value. So it's one reason why we tend to we don't wait till expiration to exit our options trades. We always close them hopefully much earlier than the expiration date. This is what the profit loss would have been if we had just bought the 20 calls and just left them in place, done nothing to them. However, on March the 6th, the price of the shares spiked up enough to give us a very nice profit, and at that point the profit was about $6,700. So we took that profit by opening this diagonal, doing a diagonal trade, which is the calendar. We rolled them out to the June calls and we rolled it up to the 43 calls. So this took profits on the $37 calls, and this was done at a credit, $2.25. So at that point we had exchanged, took the profits and plowed them into a higher strike and further out expiration. So we booked those profits. Now, at the same time, we did not want to just expose ourselves to the uh, on the new calls, the $43 calls. Didn't want to just expose ourselves to possible loss on those. So, bought the June 43.40 debit uh, put spread to protect the delta on the $43 calls, and that we used 30 of these put spreads. Now, I recommended for the April put spread, but the June was the one that was taken. So this is the result at this point. Now that changed the curve, the profit and loss curve a bit. As you can see with the diagonal, which rolled it out, we would be looking at almost a $3,900 gain, net gain. That includes the original $6,700 gain that was made on the uh, original April calls. So we've lost some of that gain that was made, but not all of it. And then that was by just the rolling out. Then this adding this vertical also helped to offset the loss on the $43 calls and put us in a position where we're now at $4,600 overall net profit. Okay, so that's the situation we're in right now. Now, I want to go over here to the risk profile and show something about this setup. For the risk profile, it only takes the what is available now at this point in time in the chronological order. It doesn't go back like the think back does. So at this point, we only have the April 27th is the next expiration available. The April 20th is already taken off the board. So to emulate the trades that we've made, I'm just substituting the April 27th calls here just to get a feel for just the dollars involved here. So originally bought the 20, but then sold those for roughly $5.70, and that was in the rolling process. We rolled to the June 43 calls, and so this net here is about the 225 credit that we got for these 20 for this rolling the 20 calls. So now it's we got a credit of 225 here, and then we also bought the June 43 and 40 debits put spread for about $1.40, as I understand. So the risk graph at this point now looks like this. So we have, as shown on the think back, we have about, the think back shows $4,600, and possibly because of the difference, in the April 20th versus April 27th calls here. We have a little difference in the value here. It looks like we have about this analysis here is showing a $4,300 gain, net gain, but even though the think back shows about a $4,600 gain at this point on April the 20th. So on the risk profile here, it's showing about a $4,300 gain. Now, Um, earnings report is coming up on April the 24th. That's Tuesday after hours, after the market hours. Earnings are always interesting for options because what happens is the options get pumped up in value, in price, usually far beyond what they're, uh, oftentimes even far beyond what's reasonable. This bottom panel here shows the historical volatility of the shares of CREE stock versus the implied volatility of the options, um, kind of the option chain as a whole. They look at the implied volatility, and so you would expect that the options should somewhat follow the historical volatility. And you can think of the volatility as a standard deviation from some average price over time. So these CREE has deviated up and down, you could say, and this is looks at it on an annual basis the way it looks. So at certain points, the historical the volatility of the stock has shifted up and down. Here we had a jump in the historical volatility, just as an example, from 27%. That's shown here, 27%. With this jump here that was made, it jumped up to 57%. And I believe this was when we were able to take advantage of last year, as it jumped to $40. 40. Let's see. Well, no, this was a jump to a high of $35, and then it made its way up even higher. Um, so, but we were able to exit our trade with a very nice profit, largely because of this jump here. So anyway, that increased the historical volatility measure for CREE, and then it dropped back again as CREE then kind of stabilized in the pricing and didn't move as much as it had before. So dropped back and then follow this kind of a move, this purple line here. Now the light blue line is the implied volatility of the options on CREE. And as you can see, you can just think of the implied volatility here as the market makers are increasing or decreasing the pricing of the options to try to protect themselves in case of a huge move in the stock. They are selling the options generally. When they're selling the options, they get a fixed dollar amount for the option, and then the puts and the calls. And then if the underlying stock makes an outsized move, they're going to have to pay a higher price, possibly to exit or to close that option and get rid of their liability on that. So they're going to price the options to try to offset the risk that they're taking on. And that's why you'll see spikes in the option pricing. Now, as we approach, every time, as you can see, as you approach an earnings date, these are earnings dates here. As you approach the earnings date, the pricing of the options moves up, and then the next day after earnings, it collapses, it drops back. So, for example, this date, the implied volatility was at 46% here, and it dropped the next day to 33%. So that was a drop of about 13%. And here again, from implied volatility of 51 to the next day 36. So again, a drop of 15% on this earnings date. Went from 54 to 39, so another 15%. And now we are at some of the highest levels of implied volatility in this whole period. And part of that is because there's generally higher volatility in the markets these days. So at this point, implied volatility is up to 81%, but it's likely to drop back into this normal range here of about 36% or so, and the historical volatility being 34%. So we've got to take that into account because that affects the pricing of options that we're going to be able to get on the day after earnings is reported. So I have this cool ability in Thinkorswim to adjust for the volatility. Right now the volatility of our June options that are still open out there, volatility of the June options, I can show just the trades that we have made, or the trades that we're in now currently. We paid about $3.45 for the current $43 calls, and paid about $1.40 for the 43.40 debit put spread. This is our risk analysis as it stands now. So we're actually down. We're actually down about $2,400, and that reflects the we had $6,700 gain on the original calls, minus the $2,400, and that gets us in the neighborhood of that 4,600 or so net gain so far on this entire complex of trades we've made. So here's where we stand now. Now, if nothing happens with the implied volatility for this expiration, this June expiration, if nothing happens, this would be our graph, and the options are implying a move of about plus or minus $4.39 this week. So that's about 10% up or down. So in order to even just get back to break even, these options will need to move like 10% up just to get to break even from the $2,500 loss point here, and then going down we'll just hold our own basically if the underlying shares go down. That's the protection of the debit spread, the put debit spread. So however, these June options are trading at about like 47-48%. They get down to, if they drop to the normal 36% or so, let's say 35%, so that'd be a minus 12% on the implied volatility. So I'm adjusting the implied volatility down, and if that happens, the value of this position would drop from a minus 2,500. I'm talking about the profit and loss would drop to about $3,700. That's what's shown here in this purple line. This is the light blue line shows the value at expiration, which is in June, and the purple line shows the value, or the profit and loss on a particular date. I'm going to show this date as 4/25, the day after the earnings report, and it would drop to $3,600. If nothing happens with the stock, if it just stays where it's at, then we would lose from $2,500 to $3,700. So about $1,200 loss in value just from sitting there, and just from the implosion of the implied volatility. That also makes that also stretches the break-even point to about $47. So it would take a larger move in the underlying shares to even get back to break-even. If without this volatility adjustment, the break-even would be about about $44 or $45 instead of stretching out to, what was that, minus 12, I think, instead of $47. So it just makes it that much harder for the options to get back to break even. So at this point, I would recommend just closing the trade. Just closing the trade. It hasn't made the move that we were expecting by this time, and so now we want to save the value of this trade. At the worst, this could lose everything, the entire amount. If it would on June expiration, if it would expire at $43, we would lose the entire value of the of all the options we're in right now. So don't want that. Going back to think back, I would like to look at the April spread versus the June spread. Now, of course, this April spread would have expired April the 20th, so we would have to go ahead and sell out of this trade for it to be worth anything. So instead of this June spread, which has this P&L result of where we're at right now, $4,600 total total profit. If we go to, instead we use the April spread, same strikes, but April expiration, and the P&L date here of April the 4th, and I'm sorry, April the 20th. This would be the profit and loss curve. Now we'd have to assume that we're going to sell, that we would sell this put spread on Friday, April the 20th at the at its value at that point. Now on April 20th, on Friday, CREE closed at $40.33, so that was 33 cents above the short strike on this put spread. So we would not get full value. The full value would be $3, which is the difference between the strikes. Full value would be $3. We would have paid about $1.20 for this put spread on March the 6th. So the difference between those two, that's $1.30 times 3,000 equivalent shares, would have given us a very nice profit, almost a maximum gain on this, to offset the loss in the 20 June $43 puts. And so that would have actually given us a nice gain. We would have been at a gain of $7,800 at this point. So the April put spread would be worth a lot more than the June put spread. That's because with the June put spread, the $40 puts still have a lot of time value on them, and so that they're not worth the spread between these two is not anywhere near maximum value at this point. Whereas in April, the April put spread is very close to the maximum value, and so it's giving a much better gain and a much better offset to the losses on the 20 June calls. So that's why we would have wound up with a much better result here. Of course, if the shares of stock had gone much higher, then the gain on the calls, the June calls, would have offset the losses we would have experienced on the April put spread. So either way, we would have been better, I think, with the April put spread instead of the June put spread. That's just making sure that's understood. So with the spreads, we'd want to take an earlier, a nearer expiration to try to get the best advantage out of the spreads. So right now my recommendation is to go ahead and close this the whole remaining position either Monday or Tuesday at the best price you can get, because it's going to take a huge move at this point to overcome the loss in implied volatility that's going to happen on the day after earnings. And that's possible that CREE could get bought out or something like that. Goes to $55 and you have a $13,000 gain, but it's not very likely. Instead of this, if you wanted to try to take advantage, try to get that, then you could take a flyer on say the April 27th $43 calls. Let's see, add a simulated trade, just the coming up weekly calls. Since you have that, you could lock in their $4,300 net gain and buy one or two of these $43 calls here. See if it makes an outsized move. These are calls, should go for about like 96 cents each. And if I show this risk profile here, let's see, if we assume that these are gone, and we're going to have a loss. See, these have an implied volatility of 95%. So if they drop back to, on the next day after earnings, they drop back to 35%. That's a 60% drop. Minus 60% to get them down to 35% implied volatility. It's going to take a huge move, but that's what you're betting on. Huge move, but if it gets to 55, you'd have a gain of $2,200 on two calls, if you had two calls here. So if they announce a buyout with earnings, then you could have $2,200 gain on two of these weekly calls. So you could use a portion of your gain on the overall position to buy these two calls here and take a flyer and see what happens. But right now I would recommend just closing this position here. We're at this would be before the earnings. If you close it now, you won't have this loss in the implied volatility. That'll be 0. And so you would close it for this current position that we're in for about a $2,500 loss. That against the $6,700 gain that was made on the initial April $37 calls is your, say, $4,300 or so net gain.